Warren Buffett recently celebrated his 86th birthday, and while he's still going strong, investors question what happens if he eventually retires from Berkshire Hathaway. A new report by Morningstar should put some concerns to rest. I'm joined by analyst Gregory Warren. Gregory, good to see you.
Good morning. Thank you for having me.
You believe Berkshire Hathaway will survive the departure of Warren Buffett and his even older partner, Charlie Munger. Things will change, though. Before we get to that, who is the most likely successor that you see?
Well, at this point, I think Ajit Jain is probably the first name that the board of directors has on the list of candidates to replace Warren as CEO of the firm. As you may already know, I mean, he's basically sort of split out his roles into three different parts. One will be the executive, or not executive, but the non-executive chairman that will serve as sort of the guardian of Berkshire's culture. The chief investment officer position is expected to be covered by Ted Weschler and Todd Combs, who've been hired in as investment managers. And then the CEO role is going to be more of a capital allocator and chief sort of position. While we like Ajit, we think he's a fantastic manager. He's done wonderful things with the reinsurance business over the years. We also feel there's a good, strong candidate in Greg-B, who's been running Berkshire Hathaway Energy for a number of years. The reason we like Abel is because he's had his hand in just about every single deal that Berkshire Energy's done over the last 20 years. Everything from vulture investing when they picked up pipeline assets and solar assets to actually buying publicly traded firms. And the way that we look at it, and basically sort of assuming that Ajit is not necessarily interested in taking over the CEO role, is that Greg-B would be a good CEO of Berkshire Hathaway overall. If we're looking at somebody that's going to be, involved in capital allocation decisions, having Todd and Ted working closely with them, and also working closely in conjunction with Ajit.
Well, let's get to that idea of capital allocation. You actually think that going forward, Berkshire will be returning more cash to shareholders. Why?
Well, I still think it's going to be a long ways out, but the notion is the company continues to generate an excess amount of cash. Buffett and Munger have historically had the luxury of sitting on large amounts of cash on the balance sheet, waiting for some big deals to come along. But I think as time goes on and size becomes a bigger problem for the firm, finding good deals that actually sort of are additive to the overall business, there will be a point at which the company will eventually mature into a returning capital to shareholders sort of business. We're not there yet. I don't think that as long as Buffett's alive and running the show that a dividend will be paid. But I think the share repurchase program that he's put in place is sort of that first sign that at the right price we will return capital to shareholders. So I think that's sort of the best way to look at it.
And growth is slowing somewhat at Berkshire in some of the businesses. What do you see in terms of future growth there, regardless of who is in charge? And what does that mean about the stock's current valuation?
Well, I think what you've seen over the last 15, 20 years or so has been sort of a gradual slowing in the growth of book value per share. And Buffett's even commented on this at times. It's just going to be difficult for them to kind of generate the outsized returns they have historically. With Berkshire, size is probably the biggest impediment for them. But when we look at the firm, we see a company that can probably grow book value per share at a high single-digit to low double-digit rate. They've done it during the last 15 years on multiple occasions. We think that's a good sort of benchmark to look at. And when you consider their cost of capital being, meaningfully below that, somewhere in sort of the 6 to 8% range, as long as they continue to earn more than their cost of capital, they should, continue to provide value for shareholders. And the stock price will follow in tandem.
Morningstar's Gregory Warren, thanks so much for your time.
Thank you for having me.
I'm Rhonda Schaffler for The Street.